There are deal states and there are money states. Why your home market may not be the best place to invest. Location, location, location is a common battle cry in real estate investing, commercial real estate in particular. Yes, real estate's about location, but that prime spot may not be in your local city or market. As commercial real estate investors, we typically default to our backyards for finding and acquiring deals. Local markets are familiar to us. So for some of us, it's where we grew up. It's where we live, it's where we work, and it's where we have personal and professional connections. I don't want to downplay the value of investing locally. There are certainly advantages to having boots on the ground, especially for finding value properties with above market cap rates and returns on investments. Having ears on the ground can open the door to undervalued properties with substantial potential upside. You may be following the path of progress and growth in your area by eyeing the west side for your next commercial real estate project. But maybe the best deal isn't on the west side. Maybe it's not even in your state. So a couple things to think about. You need to think about, how does your market compare? Maybe your market is mature. Maybe it's experiencing extreme volatility. Right now is a good time to measure it. Maybe now is a time to consider other markets. When we say a real estate market is mature, we're saying that it has reached a state of equilibrium. These mature markets are static. They're marked by an absence of significant growth or lack of innovation. Many investors are satisfied with static, with stable. Do you live in or near a gateway market like New York, Los Angeles, Chicago, San Francisco, Boston, or Los Angeles? Those are all centers of long-established commerce and population. Investors are drawn to these cities that never sleep, drawing intense competition in the commercial real estate space from some of the largest private equity funds, REITs, and foreign investors in the world. Flush with Class A core and core plus properties, these big-time investors are willing to sacrifice cap rates and profits for security and liquidity. We've talked a lot about Class A core plus properties. Go check out another article I wrote. There's an investment class for every investor. While many investors are satisfied with the status quo in bigger markets, some are tired of so-so returns and are looking to emerging markets for better cap rates, return on investment, and growth potential. It never ceases to amaze me how many folks I talk to off of BiggerPockets, off of LinkedIn, a referral from a CPA company, somebody that's doing a 1031 exchange, trading out of one of these gateway markets, and they are, going into the Midwest or to the heartland. So, as investors look elsewhere, what they're discovering is that even as they move their investment focus inland, the stability and liquidity they seek in the bigger markets can also be found in secondary markets like cities in the Midwest and in Texas. I mean, my goodness, what's going on in Texas right now? But with better cap rates and better returns. This would explain the recent exodus of California investors for greener pastures in the Midwest, where they can find properties in similar market segments, but at cap rates 100 to 150 basis points higher. If a market is experiencing a period of volatility, the temptation for investors is to park their capital and wait for the market to recover. Timing the upswing can be risky, as waiting too long could mean paying too much for an asset. And jumping back in too soon could mean taking an immediate hit because the market hasn't hit bottom yet. Why sideline your capital when there are emerging, stable markets that you can invest in immediately without holding on to cash that's being eroded by inflation? Another topic I have talked about, the deflationary effects that are going on in the economy right now. Remember that our financial system and our economy are two different things. Okay, let's talk about the impact of COVID-19 and the markets that you're living in or looking at investing in. Not all markets have been affected equally by COVID-19. Phoenix, for example, is getting hit hard by the COVID-19 induced economic crisis, with foreclosure and eviction rates twice that of the United States average. Atom Data Solutions recently released a study ranking 500 United States real estate markets according to their vulnerability to COVID-19 based on metrics such as foreclosures, homeowner equity, wages, and other factors. Of the 500 counties studied, the research found that 25 of the 50 least vulnerable counties were in Colorado, Indiana, Missouri, Texas, and Wisconsin, clearly skewing Midwestern. These markets demonstrated lower levels of unaffordable housing, underwater mortgages, and foreclosure activity. Major home ownership costs, so mortgage, property taxes, and insurance, consumed less than 30% of average local wages in 28 out of the 50 counties that were least at risk from market problems connected to the pandemic in the third quarter of 2020. The most vulnerable markets were scattered throughout New York, California, Connecticut, Maryland, Baltimore, Washington, D.C., and Hawaii. In these vulnerable states, major homeownership costs consumed more than 30% of the average local wages. The Atom Data Solutions study reinforces the COVID-19 pandemic phenomenon of young professionals and families fleeing away from vulnerable gateway markets for emerging, affordable, and economically stable markets in the Midwest and in Texas, and in search of more space and greater affordability. And investors are following that migration. Another thing we have talked about, the investor migration, the tech migration, and the worker migration. Midwest has seen a huge uptick in investors from California. Let's look forward. Location is still important, but many investors no longer restrict their search to their own backyards. It's not always about the largest traffic count in your hometown or favorable demographics. If your hometown is in a funk, don't make the mistake of sidelining your capital when you can keep your money working for you by looking somewhere else. So, before you settle for the best location in your current market, consider other markets across the United States or even outside of the United States for above market cap rates and return on investment. It might even be somewhere you least expected. Where are you looking to invest these days? If you are interested in investing in Kansas City, Missouri, and the surrounding area here, I have a full team that can help you understand this market, bring you deal flow, and get your transaction over the finish line. Thanks for tuning in, and as always, live free.